Welcome to the daily update, where I'll go over the action in the market for Thursday, May 1st, and we'll see how things look for Friday, May 2nd. Okay, had an up day, but we closed at the low for the day. Now we gapped higher, but then we chopped around, didn't see an awful lot of follow through, but ended up closing at the low. Now we're above the 50 period moving average. So we've now turned back to positive in not only the short term, but the intermediate term. We're still dealing with the 200-day moving average. So we're looking positive, but we're looking kind of toppy in the short term. And you've got a lot of people who are totally convinced we're going up. You have other people that are totally convinced we're going down, and probably somewhere in the middle is what will happen. It won't be straight up, it won't be straight down, but we are looking positive. But we've got some big economic reports that'll be coming out. The big one of the month, especially this one, is always important, but it might be a little bit more important in Friday's session. It's the employment report because we saw a real spike up in initial claims and even continuing claims. And now the focus is going to be on employment. And if that really starts to go down, then that could signal that we just might be heading into a recession. So bond market seems happy, at least on Thursday, because this weakness that's possibly coming into the economy may induce a rate cut by the Fed. But again, we have to look at the context. Why would the Fed be cutting rates? Is it because the economy's humming along and the Fed just wants to keep it going? That's one context. And that's what we were kind of justifying last fall when they made the 50 basis point cut. Well, if they cut rates this time, it's for a different reason because we're seeing economic slowdown, which may be euphoric for a day or two or even a period of times based on what the market has gone through in April with all the craziness with the tariffs and trade wars and everything. But the context is that the economy is slowing down, and that could be good for the bond market, but not necessarily good for the stock market. But we have to just take it day by day and evaluate things. All right. So, right at the open, we had a gap higher open. Now, this was on the heels of Amazon and Meta. No, not Meta. This was on Microsoft and Meta. Sorry. I was looking at Amazon and some other report right before I started recording, and I'm getting them all mixed up here. But anyway, the futures are up as I record this, but it's about 8, 9 hours before the market is getting set to open. Even though those stocks are down, they're getting hit. I know Microsoft's one of them. It might be Amazon that's the other. Yeah, it's Microsoft and Amazon that are getting hit right now. But the futures are up, but that can change. It's a long time before we're getting ready to open as I record this. But because of Meta uh, and Microsoft, okay, I don't know if I'm getting this all mixed up or not. We had a gap higher. Those earnings were taken as positive, and the futures immediately shot up after the close on Wednesday. We maintained pretty much all of that. We were up about 1%. And then after the market opened, we had economic data coming out. So we opened higher at R1. Now the spread was pretty wide with the pivot points because Wednesday's action was pretty significant. And so that makes the pivot points for Thursday wider. So we opened at R1 at 56.23. Prices rose above 56.50. That set the intraday high. That's as high as we could get. Now that's better dealing with the fact that just a few weeks ago we were under 5,000. So we're back up into the 5,600 level is pretty good. And then after that, we declined back down to R1. Then we chopped above and below R1 for quite a while. There was not a lot of conviction, but then we closed below R1. There was a big sell-off, just like we saw a big buy series of buying that came in after Wednesday's session that shot things up. Well, we saw some selling that shot things down, and we closed below R1, but slightly above 5,600. So we ended up being up 0.63%. We were up a lot more than that, and we closed, like I said, at the low for the day, and that's a little bit scary. And I'll show you what that looks like here on the daily chart. But we were back to below average with volume again. Wednesday was above average. That's the one day over the last few weeks that we saw, and even that was just barely above average with volume. We're back to this below average type of an environment again. So we are now positive in the short and intermediate term because we're above the 50 period moving average. We're still negative in the long term. Interest rates up a little bit there, and inflation is now becoming more of a concern as we had with the GDP report. And we had the core PCE come in, and that was actually a little bit more friendly. But now we're kind of focusing on the employment side of things. And then anything that comes out of the White House with the trade wars, with tariffs, and there really hasn't been anything that concrete, but the news seems to be rather encouraging nonetheless. That's the way the market is taking things right now. So the positive bias was driven by the ongoing momentum following the huge move off of the market's April low. Okay. And we got down to 4,800 level or so. I mean, that was a pretty significant decline, and we were almost going into a bear market, which means we're down 20%. But now we're back up to 5,600 into the mid 5,600 range. That's a pretty good bounce right there. And the earnings that led things on Thursday, now that I have it on in writing here, they came from Microsoft and Meta. And then the S&P has had 8 consecutive positive sessions. Okay, we'll see. What's it going to be on Friday? Are we going to make it 9? So we'll have to see how that goes. And we are back above the 50-day moving average at 55.92. That's encouraging, and that was offering overhead resistance. Well, now we're above that. So that's even more encouraging that way. And there's optimism right now about the trade war situation. And there's this hope that the Fed might cut rates sooner rather than later due to weakening economic data. Now, that should not be good news, but the market took it as good news, at least in Thursday's session. We're back under 25. We've been there with the VIX, but we're still above 20. We're coming in at 24.6. We're still above 20, so that shows there's volatility, but we are coming down, and the momentum of the VIX has been down as well. On a short-term basis, we're seeing more of our usual indicators that show that we're seeing good positive momentum. The StochRSI, Williams percent R, CCI 14, and now the 20 is on that list. Stochastics, the rate of change going back 10 periods, that's a new addition here. The slope oscillators getting a little extreme. It had been extreme negative, now it's looking extreme positive, and we're still far away from the 20 period moving average as measured by the boom indicator. Intermediate term, the CMB composite, that's 3 days now that this has been on the list. TTM squeeze, that's 2 days. This has been there. PMO studies are looking a little extreme. The bullish percent index for the NASDAQ 100. And then the advanced decline study that I do based on 10 periods, that's starting to look extreme as well. And then this, we're seeing if the scenario is going to change. The Fed's been concerned about a weakening economy and rising inflation. Well, that seems to be what's happening, but they don't plan on really doing anything right now. But the market tries to front run this and see if they can get ahead of what they think the Fed is actually going to do. The dollar was up, so we're seeing a little bit of a bounce there. We're back over 100 with the dollar. And interest rates were also up. We're at 4.23% with the 10-year yield where we had been at 4.18%. We're back up to neutral. My gosh, we spent pretty much a lot of March and almost all of April below 25 with sentiment. Now we're back up to 47. We're getting right up to the line between positive and negative where we had been at 35. We're still inverted with the 10-year to the 3 month. And as I keep saying, the 10 to the 2 year, that one's doing fine, but it's getting steeper. This one's the 10-year to the 3 month is still inverted, and that's a warning sign to us. But here is still the holdout. The ADX is still negative. The red line is still above the green line. It's a weakening negative trend, but it's still a negative trend nonetheless. And with the up day, the bias is positive. That's usually if we have an up day or down day where the momentum, I try to I subjectively take the last 2, 3, 4, 5 days and put them together. You could probably lean a little bit more to the positive side now, but for right now, I'm keeping it as mixed to positive. Okay, economic reports came in more than expected. More people filed for unemployment this in the latest reading here at 241,000, where we were stuck in the 220s there for quite a while. And we're also seeing continuing claims going up. We were in the 1.8 million range. Now we're into the 1.9 million range. And this is not a real impactful one. The S&P Global US Manufacturing PMI. The takeaway here is that it's above 50. It came in at 50.2, which is what we saw last time. When it's above 50, that shows expansion. Construction spending was weaker than expected, down 0.5%. They expected it to be up 0.3%. Last time it was up 0.6%. Then this was the other big one, the ISM manufacturing. This is not all that encouraging. It's below 50, but we've been below 50 now for quite some time at 48.7, but it was better than the 47.9 that was expected, but down from the 49 that we saw last time. Next week, we're going to get the services one, and that's consistently been above 50, and we'll see if it continues to stay that way. So here's just a look at the weekly jobless claims where we did spike up, and now the 4 week moving average is starting to go up as well. But we've been in a range bound. We've been up in this high range before, only to have it come back down. So we don't want to freak out over this. That's why I use a moving average here, and sometimes I look at a longer term chart of this to see what is the overall trend of what's happening. The continuing claims, also, we've been range bound, but now we broke out of this range a little bit, and the 4 week moving average is starting to go up. So we want to keep an eye on this. And this is a little bit longer chart where you can see, even with the blue line, continuing claims, yeah, we're coming up a little bit. But here we're just into the higher end of the range with the initial claims. And then in Friday's session, we'll get an updated version of the unemployment rate. All right, construction spending coming down, but still above zero on a year-over-year basis. Private construction, looking at residential, that's decreasing a little bit, but more or less flat, where non-residential is declining. But again, on a year-over-year basis, they're both still above zero, but declining. Month over month, we saw construction spending fall off, where it had been positive over the last number of months. And the ISM manufacturing, the total reading here is just slightly, they have it above 50 here. It actually was in a little bit below 50. That's the blue line. And then the orders is also bouncing back up here after it had been declining, but still below 50. Prices and deliveries, we have the prices actually coming down and the deliveries going up just a little bit. So you can see why the market saw this as somewhat positive. When we look at exports versus imports, they're both going up. Now, this could be some front running ahead of all these tariffs, and this data is a little bit delayed, but this is kind of what we have to go with for right now, where we're seeing an increase here. And then just looking at the index itself, they have it in just barely above 50, which the reading that I saw had us just under 50. Very strange. Okay, here's some Isabel Net blog charts. This is similar to what I show pretty much in every video. The black line is the S&P here, and then we look at the 40-week moving average, which would pretty much equate to a 200-day moving average because there's 5 days in a week. And then this is the long-term one, and I usually cover this in the weekly video, and we got kind of close to it here a while ago. This is a 200-week moving average. And that the takeaway from this is that the long-term trend is still going up. And this is the secular trend of the market, which is it can last decades. And this is still looking positive, where in a shorter term, we're rolling over a little bit here. And we're actually in a downtrend when you look at the 50 period versus the 200 period moving average. The 50 is below. And this is rolling over a little bit. So, but we're not in a bear market yet. And it would be more helpful if we could get back above the 200-day moving average, but we spent well over a month below it. And that's why this blue line is starting to roll over here. This is economically, how are things looking with heavy truck sales? Not really much of a change here. We're kind of going sideways to up a little bit, seeing a little bit stronger sales. And then the 12-month forward PE, I'll also be going over this in the weekend video with the intermarket analysis. We're just a little above 20 right now. I had it last time at 20.01. It's now at 20.02. Probably a little higher than that now with because these charts were before Thursday's session. But we're starting to look a little expensive. When we look at PE ratios, whether they're historical or forward looking, we use a 10, 15, 20 scale. And when we get above 20, that's when we're starting to look expensive. Then here's the unemployment rate. Now, this is going to be updated in Friday's session. So it has been coming down and then bounced back up a little bit. We'll be keeping an eye on this, and I'll be talking about it for Monday's video and over the weekend. And then this just looks at the total returns for the different assets since Inauguration Day, which was on January 20th, and how things have performed since then. If you love Trump, you'll find good things in this chart. If you hate Trump, you'll find bad things in this chart. But you might want to look at this and just see how different things have performed since he was inaugurated on January 20th. Then the number of IPOs, this is year over year. Now we're still kind of just getting going here. Now, when we see now these are initial public offerings. These are companies that are private, but they're going through the process of becoming a publicly traded company. And it's kind of down a little bit, less than what we saw in 2024, but we're still just getting partway into the year. This usually picks up. You notice here, this is all the dot-com stuff back in the late 90s. Just crazy, crazy, crazy. And then when things really start to go down with the economy, we see the IPOs really trail off as well. And it was they we saw a lot of them back in 2021 after the COVID crash because there was all this stimulus and money going into the market as the market was just going crazy. But then 2022, 2023, and 2024, 2022 was the cyclical bear market, and we saw a real drop off there, but it has been improving. We'll have to see if it gets a little better as the year goes on. Okay, attractive valuations for the tech sector. Okay, depending on how you look at this, this is what we're looking at here on a valuation basis, and we're coming down to a lower reading as it's been under pressure lately. And this can be enticing for some folks. We're actually below average here. And this is the NTM, which is the next 12 months. So this is looking out at their earnings, especially with the Magnificent Seven stocks. Then retail net imbalance in April sets another record where we're seeing it really high. Is this some front running ahead of all the tariffs kicking in? Could be. And then I do have another chart to show you here where for 10 weeks now, the individual investor survey has this extreme negative, and that's quite interesting and rare to see. And then initial claims for unemployment benefits. This is taking what I just showed a moment ago and just showing how this is usually goes on a year over year basis. And it's going all the way back to 2018 to right now. And we do see waves. There are periods of time when people get unemployed and periods of time when that really drops off. And then this also shows the continuing claims. And right now we're in a period of time where we typically see those going up. And then looking at the announced job cuts by reason, okay, tariffs and then the numbers, because usually people hire or companies hire around Christmas, and then after Christmas, it's like, we don't need you anymore. And then for another reason, could be market economic conditions, and then because of these tariffs. And we're seeing those going up right now. All right, here's the intraday chart where it, again, like I showed last week in one of the videos, it's off the screen now, but if you look at this just by itself, this is not a very good looking day here. We opened, we tried to go up, we hit resistance, came back down, trailed along R1, and then closed at the low for the session. What made this a positive day was the gap from Wednesday to Thursday, and that's where pretty much all the gains came from. And even with the lower move down, we still saw solid gains for the overall trading session. And we were down when I took this chart, but now right before I started recording, we were up a little bit in the initial overnight session for Friday. And we are still seeing the blue line above the red line, even though they're both coming down. We want the blue line above the red line to see growth outperforming value, to be more that it's outperforming. And this is still looking okay. the S&P growth to value ratio. When this is going up, that tends to be more positive for the S&P. The end of day charts where we had growth up, value was up minuscule on a relative basis, and growth was up more for the mid caps as well as the small caps. So we are improving here with our small cap growth to value ratio, mid cap growth to value ratio, and for the first time in quite a while, we're back above both the 200, which is the red line, and the 50 period moving averages here, even though we're still in a downtrend with the S&P growth to value ratio. But this is showing some improvement. We just need to see more follow through. We're coming back up into the rainbow when we look at the growth versus value ETF study here. And I've been showing this lately because this is large cap growth. This is really what drives both the NASDAQ 100 and the S&P 500. We're above the 50 period moving average where it had been acting as overhead resistance. And I want to show this bar when it looks a little bit better here. But when we look at discretionary, we're in a downtrend, but we're trying to bounce back up. Staples have pretty much been going sideways. We're seeing an improvement with the discretionary to staples ratio, but we are still in a downtrend here. And then we look at discretionary to staples. Now, this is the weighted version, the sectors that we look at for the S&P. It has been getting more defensive, but trying to improve. And that's what we're seeing across all these different charts. This is the equal weight version of discretionary to staples on a ratio basis, trying to bounce back up here. The tech sector, growth to utilities, which in this case is considered value, more defensive, but tech is trying to come back. Biotech, which is growth compared to healthcare, which is value, trying to improve, but in a downtrend. And then hotels to utilities, also in a downtrend, but trying to improve. So we're seeing across the board improvement here, but we need to see more improvement and more follow through with this. Then looking at different bellwethers, here's the semiconductors, which have been showing some improvement. The home builders, still negative overall, but improving. Transport's still just kind of going sideways. Retail, up a little bit, but pretty much going sideways. Regional banks showing a little bit of improvement, but an awful lot of sideways action as well. And here's the ratio from retail to S&P where it has been declining here, going all the way back to 2021. And it really hasn't started to outperform all that much, but it hasn't necessarily fallen apart either. We did bounce back up here, but we're getting back down here to the 50 period moving average, and we still remain above 50 with the RSI. Okay, now this is the holdout for the time being. The ADX continues to be negative with the red line above the green line. This is a weakening trend since the ADX is going down and it's below its moving average. We're also seeing that in the short term, and we're starting to cross below 20 here with the ADX. This is a static line that I use. The number, what I mean by static is that it always stays at 20, which has its advantages and disadvantages. That's why I put a moving average on here because that's more dynamic. It changes with whatever the ADX is doing, where the 20 level, that just always stays the same. We're dropping down below 20 in the short term. This could mean we're getting into a trendless environment, which could mean we chop sideways, or it could mean we're getting ready to turn over and look more positive. It's hard to see here because of the moving average, but the red line and the green line are not very far apart. If we have an up day on Friday, this could actually cross over and become positive. And while these lines are getting closer to each other, that's why we're seeing the ADX actually coming down. And picked up a little bit, but still below average with volume here. We were up above average on Wednesday. Now we're back to below average on Thursday. And we're still below 25 with the VIX, but that's still an elevated level since it's above 20. When we're above 20, that's when we see negative annualized returns. And we were a lot higher here with the VIX of the VIX, but it still ended up closing below the moving averages, both with the bar chart and the line chart. The momentum for the VIX continues to be down, which is positive for stocks. We ticked up, actually, we were down just a little bit with this fear gauge, and we were a little bit further down here with this other fear gauge. So these fear gauges actually declined a little bit, but minuscule. And this is the 10th week now that we're seeing individual investors extreme negative based on their survey. So I thought this would bump up from a week ago because we were starting to improve. Well, it didn't. There's still not so cautiously pessimistic. So, okay. And we are still seeing a bit of an improvement here with our risk on to risk off ratio. It was up almost 1%. We need to see more follow through. When this is going up, the market's becoming more risk on, and that's usually when it's going up. And we are improving here with our high beta. This is Apple, Amazon, Netflix, the big high flying stocks. Those are high beta. They outperform when we're going up. Unfortunately, they also outperform when we're going down because they go down faster. And we do a ratio with low beta stocks like toilet paper and toothpaste stocks. That's what people get into when they're worried about the market going down. And that's what we saw coming down here with this ratio. Now it's starting to bounce back up, but we need to see more than this. Here's the daily chart of the equity put call ratio, which was virtually unchanged. It was up just a little bit here. We're bouncing back up with the 5-day chart, but we're declining with the 10-day chart. So not really getting a straight signal there. We're still getting a very low reading with volatility risk premium. And we've been seeing that low reading now as the market's been going back up. And even when it was going down, you go back into April. The advanced decline line is still positive. It's above the moving average based on price and volume, even though these evened out or started to level off slightly. This is where we're starting to look extreme with the 10-day simple moving average of the advancers minus the decliners. We're getting above this red line. Now, we could still go higher than this, but we pay more attention to this chart when it gets above the red line, meaning that it might be getting ready to be a little toppy here. And you can match up what the reading was with this chart. And then it didn't mean we reversed, but sometimes it meant we went sideways for a while. Okay, we are positive, but we declined a little bit with the advanced decline ratio for the short and intermediate term. This is positive. Haven't shown this in a while. This is just based on price with the 19-day advanced decline line. We're above zero, looking better there, and we're above zero based on volume. And we are seeing a little bit of an improvement here where the 5 days starting to turn back up, but we're still flat with the 10-day moving average. Seeing a few more new highs than new lows, but we need to see this green expand. It's still rather minimal right now. And the reason this moving average and both the 5-day and the 10-day were going up was because we were seeing a contraction of the new lows. So this just measures the internal strength in the S&P. We came down, but we're still above the moving average with accumulation distribution. So some of our smart money indicators are showing some weakness. Not what you would expect to see on the big update that we saw here. We're also declining. We're actually turning negative here with the Chaikin money flow since the red line is now going down. And we're coming down after almost getting up to this green line with the Chaikin oscillator. These are the three smart money indicators. Positive though with the vortex. The green line's advancing as the red line's declining. We're above the moving average with the S&P with our advanced decline line studies. We're still above the moving average with the NYSE common stock, mid caps, and now the small caps are trying to make a go at getting above the moving average. And we turned down just a little bit, but we're a little toppy here with those stocks in the S&P that are above their 20-period moving averages. We've been really coming up. That's showing good short-term momentum, even though it backed off. And I'm still waiting for a good chart. You can see here where the bar for Thursday, we opened, we went up, and we closed at the low. And then we have a gap here. I mean, if you're into candlesticking, that may develop into an island reversal type of a thing. And also with our other study that we look at with the 20-period moving averages here, maybe it's a little more plain on this one where we opened, went up, came down, and closed at the low. But this is the SPY rather than the S&P 500. But we're above 70. We get a little more concerned when we get above 80. Well, right now we're at 75.8 with the short-term moving average study. Ticking down, still below 50 with the 50-period moving average study, actually going up a little bit with the 100 and the 200-period moving average study. But these are still below 50, so they're still negative. Okay, here is the daily chart where we finally, for the first time in quite some time, going back to February, we've been able to get back above the 50-period moving average. That's encouraging, and that's why we're back to positive in the intermediate term time frame. Little bit of a tick down with the 20-period moving average. We're flat with the 50, and we're still advancing with the 200-period moving average study of the S&P. Now, on a momentum basis, the StochRSI is still really strong, as is the Williams percent R. CCI 14 is back up into this extreme area, and a new addition is the CCI 20. And the stochastics in the short term, they're starting to roll over a little bit, but still extreme positive. Intermediate short term, rolling over a little bit, still advancing above the midpoint and looking positive with the long short term stochastics. Positive with the force index, looking extreme with the rate of change going back 10 periods. And it was just a few weeks ago, we were way extreme negative. So even though it's been a really bumpy ride here, the path up has been really quite remarkable. We are improving with the short-term moving average here based on 20 period, the short-term trend, excuse me, where we're above the lines and the lines are going up. So that's just showing the short-term trend is improving. Here's the 20 period simple and exponential moving averages. We're above both lines and that's improving. And I wanted to show the short-term rainbow. I usually only show this in the deep dive video over the weekend, but we're finally starting to peek our way out a little bit above the short-term rainbow after we had just been cascading down something fierce here. We need to stay above this to see these lines turn and go back up to be more positive. We're still far away on the upside from the 20 period moving average. That's what the boom indicator measures. So that's extreme in the short term. We're starting to cross back above the midpoint with the 50 period because we're back above the 50 period moving average. And we're improving, but still below the midpoint here with the 200 period moving average study. And we're getting up into the +2 channel. But again, you see this bar? The open, high, low, close, closing right near the low for the day. Not a really friendly looking bar, especially when you have the gap. It looks like it's all out here by itself, but this can fix itself. We'll just have to see how things play out on Friday. But we're up into the +2 channel now with our standard deviations chart. Intermediate term, we actually declined a little bit, but we're above zero with the balance of power, looking extreme with the CMB composite. We're turning back over to brown, where when it's purple, that's more negative. Brown means we could be in a transitional phase of going back over to positive with the go, no go system above the midpoint and showing an improvement with our highest high versus lowest low value chart. Getting extreme here with the TTM squeeze and a longer term look. This is getting to look a little toppy here when we compare it to really high readings that we've seen before. Going back up now because stocks are moving again here with the standard deviation. Again, this measures speed, not direction over the last 10 periods. We're still above zero with the ease of movement. It did come down, but we saw a bit of a tick up on Thursday. Just flat right now with the Arun indicator, negative because we're below zero with the oscillator. And this tries to measure the difference between sellers, which are in red, and buyers, which are in green. It's still coming up with a negative result. The condition of the intermediate term trend is improving. We're above the blue line and the red line, and the lines are starting to turn up. And for the first time in a while, we have been able to get back above the simple and exponential moving averages here. And that's positive. Can we stay above this? Can we build on that and keep going up from here? We're still below the 100 period moving averages, though, and they're not really acting as overhead resistance yet, but they might if we continue to try to go up. Here's all the moving averages here. And it looks like a spaghetti mess in here as we try to work our way back through these various moving averages. This is the anchored moving average here, where we were able to reclaim an anchored weighted moving average going back to the all-time high. We did that after Wednesday. We've been able to get back to it. Now, if you remember, if you've been watching these videos for a while, we were really honing in on this blue line here for quite some time. This goes back to the a low set a year ago, April, which is now over a year ago. And that was, we were hanging on to some support as we were dancing around these areas. We broke below it, we got back above it, broke below it. Now this could be acting as overhead resistance right now. And then we look at the S&P McClellan oscillator, which had been into extreme positive territory. It actually came down a little bit, but because the McClellan oscillator is above zero, we're going up with the summation index based on price, and we're also going up based on volume. Coming down after being extreme positive with the NYSE McClellan oscillator, but still above zero. So the NYSE summation index is going up based on price and volume. This actually turned negative after Wednesday and continues to be more negative after Thursday. The Swindler trading oscillator is now declining. This is actually negative when it goes down, even though we're still above the midpoint based on price and volume. Momentum, though, is positive. We're going up at the PMO. Based on price, we're going up. Based on volume, we're going up. We're getting extreme. We worked off the extreme reading here with the PMOs that are rising. That declined. It's the buy signals that are now getting extreme with their reading, and we're still improving with the PMOs that are above zero. We're positive with the Elder's Impulse system here. Again, not a real good looking bar when you look at this all by itself, but we're still positive with the parabolic SAR. We're starting to get extreme here with the slope oscillator. This is a short-term momentum oscillator, and it was really, really extreme negative. Now it's starting to get really, really extreme positive. And the MACD improving, it's positive, but still has yet to get back to the midpoint here. So all of our momentum oscillators, short, intermediate, and long term, are positive with the slope oscillator just screaming to the upside here. And we're positive with the copy curve. We're above the midpoint and above the red line. That is positive. Improving, but still in this kind of sickly looking yellow area with the Sean trend meter. It'll be more positive if we get into this green area, but if we start getting into the darker Pepto-Bismol looking green areas, that's when we're getting extreme. And we're still looking good here with the bullish percent index. We're still seeing buy signals coming in on the point and figure charts inside of the S&P, and that's looking pretty good there. We're trying to cross above the midpoint with the NYSE bullish percent index, and I know Pepto-Bismol is pink, not green, but I just use that. We're looking extreme here with the NASDAQ 100 bullish percent index, and this might doesn't necessarily mean we will reverse. It could just mean we're due for some sideways action, which wouldn't that be lovely? Then the money flow showing some improvement and above 50. That's positive. We actually came down after almost getting extreme with the ultimate oscillator, but it's still positive since we're above 50. And we're improving here. Now, on balance volume, I like to explain this from time to time. This, to my knowledge, was one of the very first technical indicators that was developed. It was developed by Joseph Granville. The drawback to this is if we have an up day, all the volume is positive. If we have a down day, all the volume is negative. But a lot of the indicators that you see throughout this video are based around the unbalanced volume indicator. So that's why I show this, and I show the moving average here. So we are starting to show some improvement since we're above the moving average and the moving average is turning up. And we're looking more positive here. RSI 14 and 9 getting back above 50. So we're seeing positive momentum in the short and intermediate term. Not sure what to make of this. This is a mass index. Since we were going up, when the criteria is met, that means that the mass index suggests we'll see a reversal. Well, we were going up that generated this signal. So does that mean we are going to have a reversal? It might not. We don't use this chart all by itself. Still working off of a praying bottom fisher, another chart we don't use alone, but this has been a buy signal and so far has been a pretty good one. And we are above this pivot point here now. But the important thing is going to be where do we close on Friday? Because this is a weekly chart. And so it won't really count until Friday's close. But for right now, we are above the 55.75 level, which is this P level. We're at 56, a little bit over 5,600. So that's looking good. So if we can have an up close on Friday, it's really going to help the longer term momentum and trend look a lot more positive. Then we are positive on the daily charts here with the Heiken Ashi. The Kagi chart is positive. It's black and pointing up. The Renko chart is positive with open blocks, and we're positive with the three-line break chart. So all of our charting ways that we measure here are positive. And we had another new X drawn in here, and it's producing a triple top breakout. So, woohoo, doesn't that sound exciting? And this is improving for the time being. After we had been in this box range, we've been chopping our way back up and generating some new X's in here. Long term, we are improving with the 150 and 200 period moving averages here. And then we're positive in the short term with all the different stock indexes, still negative in the intermediate term. And we're still negative. I'm not sure if this has been updated or not. We're still negative in the NASDAQ 100 in the long term. and also with the mid caps and the small caps. And then with bonds, we're back to positive in the short term. We're negative across the board with commodities. As they're going down, that's less inflationary for the most part, but the dollar is still in a downtrend on all time frames. And this is helpful here. Tech was the leading sector higher, and that's what we want to see. Discretionary was in third place. That's what we want to see. And then right below it is communication. That was up over 0.5%. These are the three big growth areas. Now, they don't always have to come in one, two, three, but it would really help if they consistently come in at the top of the list, where we're seeing things like healthcare, staples, and then materials, financials, they were down a bit, but almost unchanged. But healthcare and staples are more defensive. And the fact that they're going down, that's value or more defensive as the growth areas are going up. That is more positive. But we want to see that on a consistent day in and day out basis. Okay, lots of green here. St. Patrick's Day all over the place here, where we had a BPI cross above 50 with the NYSE. That's good because that's a broader market measure. Also, real estate started off pretty good with a BPI cross above 70. We had the S&P above 5,600. Now it would close right down around there. But then the Nasdaq went above 17.7, then it came down to 17.6, 5, then it went back up to 8, then it got back up to 9. A little choppy day. And the Dow is now back above 41,000. Here's the latest reading on inflation. We saw a drop off here based on the Trueflation way that they measure inflation being at 1.35%. We're still not up here to the 50-day moving average with the Dow, but it was also up a little, about 0.21%. We're positive with the diamonds when we look at the Elder's Impulse system, and we're above the 50-period moving average with the Nasdaq. That's encouraging, but we're still in a downtrend here. But we're positive when we look at the Nasdaq with the Elder's Impulse system. The Nasdaq 100, which closely feeds into the S&P 500, above the 50-day moving average, but still below the 200. Also not a really good looking bar where we opened, had the high, and then closed pretty much at the low. We want to be aware of that. Plus, with this gap in there, that could produce a scary looking chart formation. But we're just waiting to see what will happen. We're not trying to predict this. We're just watching to see what will happen. We're positive though, and above this moving average here with the Elder's Impulse system for the Qs. Momentum for the NASDAQ 100 is positive. We're above the 50-period moving average with the Qs, also closing at the low though. That's a little concerning. Small caps were up, but still in a downtrend, but trying to bounce back up here. They were the first to go into a downtrend. Here's another look at the Russell 2000 small caps, improving, but in a downtrend. Still neutral though with the Elder's Impulse system when looking at the small caps. Came right up to the 50-day moving average with the mid caps. That's acting as overhead resistance here. And we're still neutral with the Elder's Impulse system for the mid caps. We did get above the 50-day moving average with the Wilshire 5000. That's an improvement, even though we're still in a downtrend. Getting above the 50-day moving average with the total US stock ETF, but also still in a downtrend. This ratio is improving. Staples, defensive versus tech, growth. When this is going down, that's what we want. But still, the overall trend has been for this ratio to go up. Financial sector was virtually unchanged, but still coming back up to its 50-day moving average. And we like that that's holding up fairly well. The FANG index, after generating a death cross here, has been above both of these moving averages ever since then, and it was up 2.22%. These are the really big stocks. Apple ended up being up 0.39% in a downtrend. Amazon in a downtrend, up over 3%. Microsoft in a downtrend and actually gapped up above its 200-day moving average. What do you know about that? Up 7.63%. Google in a downtrend and dealing with its 50-day moving average. Meta also reporting is probably going to be a lot higher here. Well, it was higher. It was up over 4%, but closing near the low. That's not encouraging. Nvidia in a downtrend dealing with its 50-day moving average. Tesla coming back up to its 200-day moving average. It was down on the day and is in a downtrend overall. Netflix, another day, another new all-time high here. And we're seeing a bit of a strengthening here when we compare U.S. stocks in the short term with world stocks. Actually, U.S. stocks are red, world stocks are the bar chart. that's a stronger correlation, but the longer term correlation is still flat. And we are dropping. We're under $60 now with oil, which could be non-inflationary. And if you see gas prices going down, that might make you happy. And we're back above 100 with the dollar, even though we're still in a downtrend. Now, this is not encouraging. The semis to tech ratio went down and it's been declining. Earlier in 2024, when the market was just screaming to the upside, this ratio was going up. Then we topped out over the summer in 2024. This ratio has been going down, chopping sideways. We need semis to come through, and they're just not right now. This is a little bit of a warning sign to us. And why am I showing the Dow again? Okay, this might be that I forgot to delete these charts. So you get to see yesterday's charts here. This is a mistake on my part, and I do all these videos take one, and I don't want to go back and record this again. So that's a mistake. I apologize for that. We are coming up above the 200-day moving average with the 10-year yield, but we've been stabilizing for the most part, not seeing this scream into the upside like we were seeing a few weeks back. And we're coming down here with the 10-year based on price. We're inverted with the 10-year to the 3-month. And then we are improving here with our growth to value ratios. The Qs to S&P, we're not really improving that much with discretionary to the S&P. We are improving when we compare large cap growth to large cap value. So the large caps, mid caps, and small caps. This is encouraging, but we need to see this continuing. We need to see these moving averages continue to go up. And this is also encouraging. The Staples to S&P ratio coming down. That's positive. If this can continue to go down, that means that the S&P is outperforming staples, which are defensive. When this ratio is going up, that means staples are outperforming the S&P. All right, so what's our outlook for Friday? We are now positive in the short and intermediate term, but still negative in the long term. The big one's the employment situation report, and then we'll get factory orders, which probably won't have that much of an impact. And then anything that could happen geopolitically or just politically coming out of the White House, that might have some kind of an impact. We'll see if anything's announced there. We're finishing out the week with the economic calendar. Here is a look at what the previous readings were and what the forecasts were. They're expecting the unemployment rate to be unchanged at 4.2%. They are seeing a drop off in the number of jobs. They're looking at 130,000. We'll have to see how close it comes in there. Seasonality, and we're now dealing with May, where this starts at the end of April is the end of the best 6 months. Now we go into a weaker time. Well, we'll see. Everything's just kind of bizarro world right now. But for May 2nd, the Dow is positive and we're neutral to positive with the S&P and NASDAQ going back to 2002. And then we look at the post-election years going back to 1950. This will be the last time I show this. I'll switch this over to the weekly chart, or excuse me, the weekly video from now on, where it's the fourth best month and we're up 1.6% on average. We're up 12 out of 18 times. We're down 6 out of 18 times. And this also shows the returns for May, which are not necessarily stellar. April was supposed to be really good, and we did better, but we still ended up being down for the month. This also looks at May, whether we go back to 1950, that's the yellow area. We go back over the last 20 years, that's the light blue. The past 10 years is the green, and then a post-election year, and so this actually is rather encouraging. All right, the warning signs, we're still negative, but improving with the long-term growth to value ratio and discretionary to staples ratio when we look at the S&P and accompanying sectors there. We're positive with the short-term moving average steady, still negative with the 50, 100, and 200 period. Swollen trading oscillators negative, and our long-term special K, which I show in the deep dive video over the weekend, it is still negative. On the positive side, I kept these on the positive side for now because we're still above the red line with accumulation distribution, but it is weakening. We're actually turning negative with the Chaikin money flow, and we're still positive. We haven't quite dropped below the moving average with the Chaikin oscillator. That's why I kept this over here on the positive side. And the S&P and NYSE McClellan oscillators and summation indexes are positive, even though they came down slightly. The bullish percent indexes are looking good. The parabolic SAR, the momentum is positive. Possibly a little too positive with the slope oscillator. Ease of movement, money flow, and ultimate oscillator are positive, as is the vortex. Financial sector is positive, and the momentum for the Nasdaq 100 is positive. And I'm not quite sure what to make of this mass index thing here. It's just kind of its own little thing. We'll see if it turns into something or not. But a reversal signal in this case would be a reversal to the downside. But at the same time, we're still working off of a pring bottom Fisher buy signal. Okay, so the conclusion is we are positive now and improving both in the short term, but we're looking overbought and we're trying to break up above this recent range that we've been in. Can we stay up there? In the intermediate term, we are positive and showing an improvement there where we're still negative in the long term since we're below the 200-day simple moving average and we are in a downtrend. Thank you. I hope you found this helpful. Have a great day on Friday, and I will talk to you in the next video.